So you want to buy your dream home. The one with the kitchen island you've been screenshotting for years. The backyard big enough for the life you've been picturing. The front door you get to walk through and finally think, I own this. It looks like the finish line, the one purchase that ends the search, instead of starting a new one. Subscribe before we start, because by the end of this you'll understand why the mortgage payment, the number that dominates every conversation about buying a house, is quietly the smaller half of what a dream home actually costs you, and why the homeowners who feel blindsided a year in are almost never the ones who miscalculated the loan. Let's start with the number everyone actually budgets around, the purchase price and the mortgage sitting on top of it, because this is where almost every buyer's math begins and, for a lot of people, unfortunately ends. A median-priced home, financed with a typical down payment, produces a median monthly mortgage cost that recent census data puts right around $2,000 a month for principal and interest alone. And that's the figure most buyers walk into a lender's office already knowing, since it's the number pre-approval letters are built around and the number that determines whether an offer even gets accepted. What almost nobody walks in already knowing is that the mortgage is genuinely just the opening chapter. Recent survey data on actual working homeowners shows the average household paying close to $24,000 a year on top of the mortgage, covering utilities, maintenance, renovations, property taxes, and insurance, which works out to nearly $2,000 a month in costs that never show up on the closing disclosure and rarely get mentioned in the same breath as the mortgage payment during house hunting. Stack that non-mortgage figure against the mortgage itself over a full 30-year term, and total realistic cost of homeownership on a median home lands somewhere in the neighborhood of $700,000, a number that would stop most buyers cold if a lender ever actually printed it on the paperwork they sign. So how does the money actually flow once you own the place? Because this is where dream homes specifically, the bigger lots, the pools, the custom finishes, the homes that cost more than the median to begin with, start behaving very differently from a starter home. Property taxes are the first major current running cost, and they vary so dramatically by state that the same priced home can carry a wildly different annual bill depending purely on where it sits, ranging from well under 0.5% of home value a year in the cheapest states up to over 2% annually in the most expensive ones, meaning a dream home purchase in the wrong state can carry a 5-figure annual tax bill before a single other expense is even considered. Homeowners insurance is the second major line, and it's become the fastest growing cost in this entire category, with premiums having climbed roughly 70% nationally since 2021, and continuing to rise faster than household income, driven by more frequent severe weather events and rebuilding costs that keep climbing, and a larger, more elaborate dream home with premium finishes and a bigger footprint to insure, carries a proportionally bigger premium on top of an already inflated baseline. Then there's maintenance. The category financial planners consistently recommend budgeting at somewhere between 1% and 4% of a home's value every single year, and on a genuinely upscale dream home, that percentage applies to a much bigger number, meaning the same rule of thumb that costs a starter homeowner a few $1,000s a year can cost a dream homeowner tens of thousands, especially once you account for the reality that bigger homes have more roof, more HVAC capacity, more square footage of exterior to maintain, and often more elaborate systems, pools, irrigation, smart home infrastructure, that all eventually need service or replacement. Now for the stuff nobody warns you about before the offer gets accepted. First, the maintenance budget isn't a steady monthly drip. It's lumpy and unpredictable, in a way that catches even financially disciplined buyers off guard, since a household can genuinely go a year or two with minimal repair costs and then face a single $10,000 system failure out of nowhere. A roof that needs full replacement running $8,000 to $20,000 depending on size and material, a water heater failure landing somewhere between $1,000 and $3,000, or foundation issues that can run into truly serious money on a larger home with a bigger footprint sitting on top of it. Second, the first year of ownership specifically is dramatically more expensive than every year after it, since new buyers routinely spend well over $80,000 in that first year alone, once furnishings, immediate renovations, and the inevitable list of things the previous owner never quite got around to fixing are all added together, a number that consistently surprises even buyers who felt genuinely prepared going in. Third, if the dream home sits inside a homeowners association, which a meaningful share of newer upscale developments do, that adds another layer entirely, with association members paying an additional several $1,000s a year on average, and those dues carry the added risk of special assessments, sudden one-time charges levied on every homeowner in the community to cover a major shared repair, that can arrive with little warning and no real way to opt out. Fourth, property tax assessments don't stay fixed at the number the previous owner was paying, and a majority of current homeowners report their tax bill rising significantly since they bought, which means budgeting around the seller's disclosed tax history rather than researching what your own assessment will actually become. Once the sale resets, the taxable value is one of the most common and expensive assumptions buyers make. Fifth, location changes every single one of these numbers simultaneously, with total non-mortgage homeownership costs ranging from around $12,000 a year in the cheapest states to well over $30,000 a year in the most expensive ones, meaning the exact same dream home, same size, same finishes, can cost a genuinely different amount to simply own and maintain, depending entirely on which state line it happens to sit inside. So, who's actually managing this well? And what does it look like to own a dream home without the finances quietly falling apart underneath the granite countertops? The buyers who do this successfully are, almost without exception, the ones who ran the full ownership math before they ever made an offer rather than after, building in a real maintenance reserve of 1 to 2% of home value set aside every single year, regardless of whether anything actually broke that year, treating it the way a business treats a capital expenditure reserve, rather than an optional line item to skip when money feels tight. They're also the buyers who shopped insurance carriers aggressively, rather than accepting the first renewal quote, since premiums for comparable coverage can vary substantially between insurers, and the buyers who research the actual post-sale tax assessment for their specific property, rather than assuming the seller's old tax bill would simply transfer over to them. And critically, they're the buyers who built genuine breathing room into their monthly budget, rather than stretching to the absolute maximum a lender approved them for, since a mortgage pre-approval reflects what a bank is willing to lend, not what a household can comfortably absorb once maintenance, insurance, and property taxes are layered honestly on top of it. How do people actually get hurt financially on this? Almost nobody loses their dream home because they misjudge the mortgage payment itself. Lenders are generally quite conservative about what they'll actually approve. They get hurt because they budgeted right up to that mortgage number and left no real cushion for the $24,000 a year second half of the equation, and then a single major repair, a roof, a foundation issue, an insurance premium that jumped after a regional weather event, arrives in the same year as a property tax reassessment, and a household that felt financially comfortable on paper suddenly finds itself house-rich and genuinely cash-poor, unable to cover an expense that a properly funded maintenance reserve would have absorbed without any drama at all. Okay, so what does a realistic year of dream home ownership actually look like? Take a household that bought a home priced meaningfully above the national median, financed with a conventional mortgage, in a moderate-cost state. Their mortgage alone might run somewhere around $3,000 to $4,000 a month depending on the loan size and rate. Layer on property taxes, insurance, utilities, and a properly funded maintenance reserve, and total non-mortgage costs realistically land somewhere between $1,800 and $3,700 a month, depending on the size and age of the home, pushing total monthly cost of ownership into the range of $5,000 to $8,000 once every category is honestly included, or roughly 9% of the home's value annually when everything is totaled together. Now the more painful version, the household that skipped the maintenance reserve entirely, assumed the seller's old tax bill would carry over, and accepted the first insurance quote they received without shopping it. That household can look financially identical to the first one on the surface for a year or two, and then absorb a 5-figure surprise, a full roof replacement, a spiked insurance renewal after a bad wildfire or hurricane season nearby, and a property tax reassessment landing in the same 12-month window, turning what looked like a comfortably affordable dream home into a genuine financial strain almost overnight, despite the mortgage payment itself never having changed at all. So yeah, you can buy your dream home, and if you budget for the whole picture instead of just the mortgage, it can genuinely be the best financial decision you ever make, building real equity while a renter's payment builds nothing at all. Most buyers who get burned by this purchase aren't the ones who bought too much house on paper. They're the ones who never budgeted for the second half of the bill that never shows up on the mortgage statement. The ones who do this well aren't the ones who found the most beautiful house on the market. They're the ones who understood, before they ever signed anything, that the purchase price was only ever half the question. Subscribe, and we'll do this again next week, with the next dream that comes with a real spreadsheet attached to it.